Today, we are undertaking a deep financial analysis and investment outlook for Planet Labs, a critical player in the aerospace and defense industry specializing in daily Earth imaging and analytics. For anyone following the market, the stock's performance has been nothing short of astronomical this year.
Indeed, it really has. And that rapid ascent creates our central tension, doesn't it? The question we really need to address is whether Planet Labs' current premium valuation, which is, fueled by that intense market enthusiasm and several key strategic contract wins, is fundamentally justified by its underlying business model. Or if the deep chasm between its trading price and its intrinsic value, coupled with these ongoing operational losses, signals, excessive market speculation.
Right. And I'll be arguing that the recent tangible operational successes and powerful strategic catalysts are not only real, but frankly robust enough to fundamentally justify the stock's current premium and its impressive momentum. You see, the market is looking forward and it likes what it sees.
And I will present the necessary counter-perspective that the company's core financial metrics, these persistent profitability risks, and, let's be honest, these structural challenges associated with being a capital-intensive space company suggest that the stock is currently trading at levels significantly detached from any measurable intrinsic value.
Okay, well, let's start with that market confidence then, because I think it is based on results. We have seen explosive investment interest evidenced by a stock return of over 465% in the past year alone. That's huge. And this momentum isn't just sentiment, it's anchored by strong forward visibility. The company has achieved a record revenue backlog surging past $736 million. That's a phenomenal 245% year-over-year increase. That backlog, importantly, is not speculative. It's contracted revenue, providing robust confidence in future streams.
The current market capitalization is fundamentally disconnected from intrinsic value. If we apply traditional financial models, specifically discounted cash flow analysis, the estimated per-share value sits alarmingly low, somewhere between, $0.77 and $1.36. This is not a slight premium we're talking about. This is a massive, gaping difference compared to the recent trading price of $13.45. This gulf suggests the market is pricing in nearly a decade of absolutely flawless execution.
Look, this isn't just a satellite operator. This is an Earth-as-a-Service platform. Our source material shows the gross margin stands strong at nearly 59%, demonstrating efficiency in the core service delivery model. And critically, management has achieved its third consecutive quarter of positive Adjusted EBITDA. Now, while I acknowledge that adjusted metrics are, management defined, achieving positive Adjusted EBITDA demonstrates that the core business, before factoring in large non-cash items like depreciation on the satellite fleet, is scaling toward positive cash flow generation.
Dismissing Adjusted EBITDA as merely a management metric is maybe too easy, but we must ask what that adjustment hides. It often backs out the significant depreciation and amortization expenses tied to these capital-intensive assets. In this case, satellites that cost hundreds of millions to build, launch, and maintain, and, crucially, which have finite lifespans. So despite annual sales of $262.47 million, Planet Labs remains deeply unprofitable, reporting a net loss of negative $90.45 million. The actual profitability metrics are dismal. Return on equity is a poor negative 19.90%, and return on assets is negative 13.35%. This is the real financial picture.
That's a fair accounting perspective, sure. But it misses the essential characteristic of high-growth technology platforms. When we look at that price-to-sales ratio of 15.78, you're analyzing it through a traditional capital-intensive industrial lens. You're missing the vital software-as-a-service or SaaS component of their model. The majority of that growing backlog is annual contract value, ACV, which is highly recurring and potentially high margin once the infrastructure is deployed.
I just have to push back on that interpretation. While the sales growth rate is compelling, over 20% historically, relying solely on PS is speculative, deeply speculative, in the face of these net losses and a negative operating margin of over 30%. High PS multiples are typically reserved for software companies that are, pure play subscription models with minimal capital expenditure, not for a company that must constantly refresh and expand physical assets in orbit. The DCF model is signaling caution precisely because that gap between, say, $1 and $13 requires the company to successfully convert its entire revenue backlog and strategic investments into operating income almost immediately and flawlessly, which, well, brings us neatly to execution risk.
Execution risk is why the market is paying a premium for the strategic transition they're making. The Pelican and the hyperspectral Tanager fleets aren't just new versions of older satellites. They fundamentally changed the total addressable market. They moved Planet Labs from providing high-volume Earth imagery to delivering high-value, high-resolution, predictive analytics and specialized data services, like tracking agricultural health or resource depletion. This pivot toward AI integration is the key value driver that backward-looking DCFs simply cannot model effectively. And furthermore, you mentioned volatility. The beta is 1.99. Can you name a truly disruptive tech stock that wasn't volatile in its growth phase? High beta often just reflects the market's pricing of revolutionary potential, not necessarily recklessness.
Okay, I agree that the strategic pivot is essential for the story, but that speculation is magnified by structural issues. We also cannot ignore the context of how this valuation even originated. The company's public debut stemmed from a SPAC merger, which is now, let's not forget, the subject of securities fraud investigations focusing on potential misleading statements made prior to the deal. That shadow adds a profound layer of risk and challenges the historical credibility of the business story, making the current high valuation even more difficult to defend.
Let's pivot then to the company's ability to fund these necessary strategic expansions. You touched on the operational cost structure, and I agree that managing costs while scaling is complex.
It's more than complex, it signals struggle, wouldn't you say? Why, if the growth engine is so powerful, did the company announce multiple workforce reductions, including a sharp 17% cut just this past June? That action, explicitly aimed at improving operational efficiency, suggests a failure to manage selling, general, and administrative costs while simultaneously maintaining these highly specialized and constantly depreciating satellite constellations like the Doves and SkySat fleet. My question remains, how long can they fund operations, especially the large capital expenditure for the necessary fleet refresh and expansion, when the core income statement is, well, bleeding cash?
That is a legitimate concern, I'll grant you that, but we must frame the layoffs as strategic realignment, not necessarily desperation. Every high-growth company has to optimize its structure to achieve profitability eventually. And the reason they can manage this transition, I believe, is the strength of the balance sheet. Planet Labs maintains a solid liquidity position. The quick ratio and current ratio are both sitting at 1.74. This indicates strong short-term financial health and the capacity to meet immediate obligations while they optimize personnel costs. Furthermore, their leverage is remarkably low, which gives them substantial headroom. The debt-to-equity ratio sits at only 0.04. That's practically nothing. This fortress-like balance sheet allows them the runway to manage the necessary capital expenditure for deploying the new Pelican and Tanager fleet. And their financial agility is evident in the private upsized offering of $460 million in convertible senior notes due in 2030. That provides low-cost capital specifically earmarked for growth initiatives, ensuring the expansion can proceed without immediately draining existing cash reserves.
Access to cheap capital is, well, it's a temporary fix, isn't it? It's not a permanent pathway to sustainable profitability, particularly when that capital is being deployed essentially to offset negative operating margins.
Well, the fundamental structural strength that supports future profitability, I'd argue, is their strategic revenue mix, specifically their deep penetration into the stable government and defense sectors. We saw Q2 FY26 revenue growth of over 40% year over year in this segment alone, and that's secured by major sticky contracts like the NGA Luno B award and the U.S. Navy renewal. These are highly reliable, multi-year recurring revenue streams. This insulates them, to a degree, from typical commercial market volatility, offering the kind of high revenue visibility that offsets the short-term negative income picture.
That very reliance on large government and defense contracts is also a core risk. It makes the company highly vulnerable to sudden shifts in budget priorities or political winds, the very kind of single customer dependency risk that should worry long-term investors. However, if we are evaluating belief in the company's future, perhaps we should look at the insiders themselves.
What do you mean by that?
I am referring to the pattern of insider activity. We've seen multiple key executives, including co-founder and CEO William Marshall and CSO Robert Shingler, executing significant share sales back in October 2025 at prices around $15.50. When executives are selling substantial blocks of stock near the recent high point, these are the individuals with the most comprehensive internal knowledge of future prospects and financial health. When the people closest to the data are offloading shares, well, it fundamentally undermines the aggressive bullish narrative of explosive sustainable growth. It suggests that they believe the stock is fully priced or perhaps even overpriced regardless of the backlog or the future potential of the Pelican fleet.
But looking at the entirety of the financial data and the operational momentum, Planet Labs still presents, I believe, a compelling long-term investment case based on demonstrable revenue acceleration, a dominant position in the daily Earth as a service market, and these powerful strategic tailwinds from AI and next-generation satellite technology. The market, I contend, is correctly valuing the powerful future cash flow visibility provided by that massive, growing backlog, even if traditional backward-looking metrics currently suggest a high premium.
That's an interesting point regarding the market's forward view, though. I would naturally frame it differently. While the growth catalysts surrounding Pelican and Tanager are certainly real, yes, the tangible financial reality remains a company saddled with deeply negative profitability metrics and a valuation that is extremely difficult to justify based on fundamental analysis. Investors must rigorously weigh the excitement of strategic technological execution against significant operational efficiency challenges and, frankly, the tangible risks highlighted by that executive selling and the ongoing legal scrutiny related to the merger history.